Okay, Tyler, it's time to talk about ChargePoint Holdings again. It's been a minute since we took a look at the company. These are the folks that make charging stations for EVs, and they have some services to help manage fleets of vehicles. You ready to go through a couple of potential positive things, but also some things investors really need to be paying closer attention to with ChargePoint?
I'm always going to be the one focused on the more cautious things because that's just who I am. But yeah, let's go through all of it.
I think most investors, especially in these companies, these kind of startup-y trying to make something still burning a lot of money, need to spend more time focusing on the reasons for caution. I'm Jason Hall. This is The Smattering. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, check out our special link. Go to fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. You might want to check that link out after this video. Okay, Tyler. So I talked about it a little bit there, but just to read what ChargePoint does. In the past, an analogy we've used to talk about this business and why neither of us are particularly bullish on it is it's like a gas station that doesn't sell things that gas stations do that make money. And I had a couple of YouTube commenters that said, you don't understand the business. They're not making money selling the electricity. It's like, the acronym wasn't perfect. Yes, we understand the business. ChargePoint makes money two ways. They make money selling the hardware. They make money maintaining the hardware and providing services to those that want to manage like vehicle fleets and that sort of thing. Tyler?
Yeah, they're not the gas station. They're the manufacturer of the gas pumps at the gas station
There you
with
go.
a
There
subscription
you go.
model built on top of it for fleet management.
And I've talked about that subscription model in prior videos, the services that I do think that is a value add they offer, but I think it's a niche value add. It's not a massive value add. Here's the big one. What hasn't changed, and we'll talk more about this in the end of the video, but ChargePoint's trying to make a money with the value add against a bunch of competitors that it's a bolt on that is a cost of doing business for them to make money selling something else, like Tesla as an example. Their focus is not making a ton of money with their charging stations. At any rate, let's get to the point. Tyler, there were a couple of recent press releases that I think are one of which I think is certainly favorable for ChargePoint. I'm going to pull it up on the screen and share this press release. This was from October 26th, so it's been a couple of weeks ago, but it might not have gotten a lot of attention. And that's ChargePoint saying they're accelerating fleet electrification with new suite of management applications. They work with a town or a business that has a lot of vehicles in a fleet that they operate that they're transitioning over to electric. And they sell the chargers to that entity. They also want to sell ChargePoint's fleet software platform. And you see right here, they highlight some of the key things that they've bulleted out here that it can be that they can take advantage of. And this last one, like I think is a good one. For example, maximizing when you charge those EV vehicles based on how much you're paying for power and wind, like little stuff like that, that their software can be used for maximizing and optimizing routes. But also one of the things that they're talking about doing is helping their fleet customers manage their whole fleet, not just their electric vehicles, right? Their whole fleet. So again, I think this is a positive. This is an example of a positive thing that they're doing. Tyler, this one maybe not being a positive here. I'm going to bring it up, and this is one I think maybe you can comment on just a little bit here.
Basically, what this was is that Point is now building the a charger that is adaptable to the Tesla and a particular plug that the Tesla designed for its charge vehicles, which is slowly becoming industry standard. I believe Ford was the first major auto manufacturer to come out and say that we're going to use the Tesla standard and
Right.
it's going to allow us access to the Tesla supercharger network. There's been a couple other cents that have also mentioned that they're going to be getting onto this. So basically,
General Motors, several of the other
yeah.
startups,
So
basically everybody's
yeah,
lining up.
what we have seen over time is that basically the concept of everyone having proprietary plugs for all of their different EVs, it was dumb, right? Imagine if you had to go find a particular gas station because they had the square gas pump versus the circular gas pump. It's the same idea, right? Like to have all these different plugs for different ones and having proprietary designs was stupid. Never made sense. The only way that these things ever make any sense is it's accessibility. Everybody can use them. You want every single vehicle to be able to plug into them. So this table stakes for ChargePoint, and they're glad to announce it, which is nice, yes. And they obviously need to adapt to the times, but like this is table stakes for the industry right now. You can't just make some proprietary plug and expect everyone else to use it. You have to build to the standard.
The first press release that we shared, this is a way that they can maybe build some moats, make their service a little stickier, make it easier to sell more charging stations, is that the services, right? Through their EV management and their fleet management applications. That's a value add. That's a moat. This press release with switching over to the NACS connector, like Tyler said, it's table stakes. A comparison that I think is useful is when AT&T and T-Mobile and Verizon started hyping their 5G networks. They didn't have a choice, right? That's you. They have to make those investments because if you're the one that doesn't, guess where all your customers go? To your competitors. So again, it's good. It's a positive they're doing it, but this is not creating any durable moat. This is simply table stakes, like Tyler said. So that's important. I think, Tyler, it is time to move to the not quite so great news in the
No,
recent press releases from ChargePoint.
no, this was actually back in mid or
That's a
early
month ago
October,
at this point.
about
We're
a
about
month
a
ago.
month ago.
Basically, what they did is they announced a capital raise, which, in management's best words, they were able to put the best spin on it, saying how they were able to raise about $232 million through its at the market equity facility or offering facility, which basically means like when we want to offer equity, we can.
There's
Companies can raise
basically
capital.
two ways that companies, when they sell a large block of shares, when they're selling, the company is selling it directly. They either do a private placement where they have an investment bank that's marketing for them and they find a large institutional buyer and they sell it directly to them, or they sell it at the market, which is literally they're selling it into the market that day. And
Right.
that's what ChargePoint has been doing. And they said they get this commitment from an institutional investor to participate in its at the market program. That's dilution, right? Both of those. That's the thing to remember is that they're taking that pizza that's ChargePoint and cutting it up into smaller pieces. Each share is now worth a little bit less of ChargePoint because of these new shares that they issued that they used to raise this capital.
Yes, but that wasn't the most important part, at least not how you and I saw it when we started looking at this and started breaking down how all of this worked. What was more important was the part at the bottom. As you're pulling it up, I'll talk about it a little bit. The company took out a loan. I believe it was earlier in the year. I
Last
can't
year,
remember.
2022.
Last year, 2022. In this particular loan, it was a loan that is very peculiar in its ways built. It's called a PIK toggle loan, which basically means, or payment in kind, sorry, payment in kind
So
toggle
it's
loan.
it is a convertible pick
Yes,
toggle. So
that's a
stay
lot
awake,
of
people. Don't
descriptions
fall
on the
asleep.
loan. Yes,
Don't fall asleep.
we're
What
gonna,
that means, Tyler, is first of all, the convertible part. It can
yes,
convert
convertible.
into shares.
It can convert into shares. So it's a
Right.
loan, pays an interest rate, and that if the share price hits a certain price over time, then all that loan, instead of having to repay the loan in full, you get to just instead convert it to shares.
So when they first wrote the deal, you'll see I'm highlighting it on the screen.
Right.
The convertible price was $24 a share. That was the
Yes.
convertible price, right? So you needed the stock to be above. Ideally, if I invested in this particular scheme, ideally I would want the stock to be above $24 a share because it converts at 24, which was basically my price. And if it's worth $35, then immediately I've made an $11 a share profit, right? So that's the way you want it to
Right.
work. Now here's the other part. Let's talk about the
Kind part. Let's do
pick
that.
part, right?
Right. Payment
So
in
if I'm
kind or
paying, go
PIK.
ahead.
What payment in kind means is that instead of actually paying cash each quarter or each month or however frequent that you actually have to pay your loan back, you pay the interest accrues onto the total of the loan because you're
In shares.
in shares, or in this case, the lump sum of the loan, right? So if it's a $300
Right.
million loan and it's 3.5%, then at the end of the year, if you haven't paid any interest payments, then you're gonna add 3.5% to that total at the end of the year, or depending. That's I'm being very general when I say this, and that's basically how
Well, we
much that
have
is
the
worth.
specifics here. The
Right.
specifics we have here is that the way that this specific one was built, that $24 conversion price, so that initial terms, $24 conversion, 3.5% cash
Or 5% payment in kind.
or 5% in kind. Right.
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 Now, with this issuance of new equity, this is how it changes. Because they raised money, the terms of this deal changed. And like we said, we've been alluding to here. So instead of a 3.5% cash payment, Now this loan requires a 7%. Instead of a
Right.
5% payment in kind, it's an 8.5% payment in kind. So all of your, basically the interest rate on this note or this loan debt went up significantly. And
Yeah, I
also,
think you could say the cost to service this loan full stop doubled because again the cash servicing cost doubled, the conversion price cut in half. So the cost to service this loan full stop doubled. So this small amount of capital that they raised comes with a big hook of higher costs to service the debt, whether it's cash costs now, which doesn't seem like that's the way they want to do it, considering that they're raising cash because they're burning cash. That payment in kind is at a higher rate as well, on top of the fact that the conversion price has been cut in half. Tyler, I want to talk about one last thing. Again, we mentioned, and again, this is why I think investors should be very cautious right now with ChargePoint. Again, we talked about these terms not being favorable. Looking at the balance sheet, you see here in purple, this is cash. This is before this deal was done. So this was at the end of the prior quarter. They won't report again for another month or so. Raised a little bit of cash since then, but they've also probably burned cash again because you look at their cash burn rate. And again, you looked at their existing long-term debt of about $300 million, which is going to cost more to service now. You take all of those, you take those things we know about, it's cash burn, it's balance sheet. Take those things, and then you combine it with the share price of $3.11 a share, which keeps falling even as we're talking about it, Tyler, here in real time, versus that $12 conversion price. There's a lot of reasons investors should be super duper cautious, even with these revised terms that give it more time, give it a little more capital to work with, much higher costs. Things are not really looking all that favorable.
we've been around here, we've been reviewing companies for you and I a long time together. And companies that take on debt financing like this are not doing it from a position of strength. They're typically doing it from a point of distress. And when you're doing things in distress, it's very hard to turn it around.